good evening, and welcome to Navigating Inheritance and Estate Tax for U.S. Citizens in Germany. Tonight, you're going to hear from myself, Ariel Tucker, Emily Haynes, who's a CPA with Expat Tax Solutions, Petra Korn, who is a German-American lawyer, and then Ralph Otto, who is our German tax expert this evening. So just as a reminder, we are not your advisors unless we have an agreement in place. This is just general advice that may or may not be applicable to your unique situation. So be sure to speak with your financial advisor, your accountant, or lawyer for advice directly related to your situation. We are recording this webinar today, so if you post any comments or questions, it may be part of our recording. So today's agenda. We're going to run through our introductions. We are going to do an overview of estate tax versus inheritance tax. Really, what are the differences? Why are we all here this evening? We're going to go through U.S. estate considerations with Petra, U.S. estate tax considerations with Emily, and German inheritance tax considerations with Otto Dare. And hopefully we'll have time to get into our cross-border case study where we're all going to be participating in the conversation. And I'm Ariel Tucker, like I said. So I'm a U.S. expat, and I've been personally and professionally exploring cross-border and tax and financial planning issues for over 15 years. I own and operate Connected Financial Planning, and we say we are fee only because we are only compensated by our clients, and we do not sell any products. I've been writing for Bloomberg Tax and been featured on numerous media outlets, including CNN, Yahoo Finance, and Consumer Affairs. So please feel free to connect with me and Connected Financial Planning on LinkedIn and Facebook, where I do engage with the broader expat community on tax, financial planning, and general expat considerations. I'm going to quickly introduce Emily. Emily Haynes is a CPA, and she operates Expat Tax Solutions. She has been living between Germany and the US for over 15 years. She currently spends her summers in Germany, and you'll see us generally meeting up and doing events in the summer. And then we have Petra Korn joining us as well. And Petra Korn is really unique because she is both qualified on the US side. She's in California, bar certified, and then also is a German lawyer as well. And then finally, we're very lucky to have Ralph Otto, who is our German tax expert, to speak more on German tax considerations. So Ralph lives and works in Berlin, and he's been appointed as a certified tax advisor way back in 1994. And since 2001, he has assisted clients from abroad, especially with their ventures in Germany, particularly in real estate and startups. He has a degree of Masters of International Taxation from the University of Hamburg. And since 2022, he has been a partner and managing director at ETL Otto Dare and Kollegen GmbH with a team of approximately 30 people. So he consults his clients in the field of tax, accounting, and payroll. Okay. So let's get started with U.S. citizens and German tax residents. Okay, so we are really getting into, the meat and potatoes of this today. So if you're looking for more of a high-level view of U.S. And German tax differences, especially on the personal taxation side, definitely go back and check some of our other webinars on our YouTube channel, because today it's really about bringing together a panel of experts who are just as passionate as me about the U.S. and German cross-border, estate and inheritance planning. When I think about questions that I receive from, individuals who want to move to Germany, who are living in Germany, still have U.S. ties, one of the biggest questions I have is about the German inheritance tax and whether that applies to them or not. A lot of people will cite to me like, oh, there is an estate tax treaty in place. But at the end of the day, we're actually discussing different types of taxation. And so when we say, yes, there are treaties in place, but there's different taxation in this scenario. So we're talking about, German inheritance tax may actually be credible on your U.S. Estate tax return, but that estate would need to exceed the federal estate tax thresholds. And then on a state-by-state basis, you need to consider, how would you be able to apply foreign tax credits if there are lower thresholds. And German inheritance tax is really unique and again, often a surprise for people because it applies even if you are not a German citizen. The consideration really starts with when you become a German tax resident. Um, and there is no change if you are a dual US German citizen, you still need to consider US and German reporting rules and requirements. The US federal estate tax exemption increases annually, so it's adjusted by inflation. And it is currently the $13.99 million, and that's per person. So if we have a married couple, we double that for 2025. And Trump doubled this estate tax exemption when he was in office. So we expect that estate tax exemption is going to continue to stay pretty high in the coming years. Okay, so estate taxes are really taxes on the privilege of transferring property to your heirs. It's the estate of the deceased that is liable for the tax. So it's whoever has passed away, it's all of their assets that makes up the estate, and that is the U.S. tax system that most U.S. expats are familiar with. And then we have inheritance tax, which by contrast is a tax on the privilege of receiving property from a deceased benefactor. It is the living heir who pays the inheritance tax, not the estate or the deceased. So a few just key points here as you look over this slide is, in the US, actually less than 2% of estates are subject to estate tax. So that just gives you a scope of, that $13.9 million threshold is so high that less than 2% of estates are actually going through that federal estate tax process. And on a state level, so again, we have the federal, which includes all the states. We also have individual states. We have 50 states in the US, if you don't know that. There are 15 states and DC that have a state tax. The lowest threshold right now is the state of Oregon, which only has an exemption of $1 million. A couple other notable states, New York is about 50% of the federal exemption. So with the federal exemption being around 14 million, New York is roughly 7 million. And then California does not have a state tax. There's a couple of states that actually have inheritance tax, but those have kind of been phasing out in the last few years. In New Jersey, for example, abolished their estate tax. And then for inheritance tax, it works a little bit differently than German inheritance tax. I'm not going to get into it. It's just important for you to highlight and know that if you're considering family estates in the US, each state is going to have their own rules to consider. Another planning consideration here is, if you have a surviving spouse in the US, you may still want them to file an estate tax return, even if they're below that $13.9 million exemption, just to make sure they make that portability exemption for the predeceased spouse to grab their unused exemption. So there are still reasons to file an estate tax return. And then we can just start to highlight here the German inheritance tax. You can already start to see the difference in the values, right? We're talking about $13.99 million in the US. And then on the German side, it's very low, 20,000 euros to 500,000 euros. That's very much dependent on the tax-free allowance is very much dependent on the relationship with who is actually receiving the funds. And then Ralph would get a little bit more into the reporting requirements, but it's really you as the person who's the beneficiary, the person who's received the inheritance, it's your duty to inform on the inheritance tax. Okay, now we're going to get into Petra's side and we'll let her kick things off here.
Okay, so like US, like a trust, especially in states like California, can be good strategies to avoid probate. And so the only issue is if we have a US citizen that lives in Germany and has assets in the United States, then the issue becomes like, if we create a trust in the States, in California, that the institution of the trust is not recognized in Germany. So we have to, that requires careful drafting and consideration and planning in what the best strategy is. So, and as I mentioned, the US trusts are not recognized as independent legal entities in Germany. There are, like, I think, Ralph, you can probably expand on that a little bit. There are family foundations and other strategies that US residents of Germany may take advantage of. But the question is, like, how is a US trust that is already established or that we can establish, how is that regarded for tax purposes in Germany? So
You go to the next slide here. And let me know if you just want me to skip this one and go to the
no, I mean, the US, I can quickly address it, but I think I would rather leave it to the professionals with the US federal estate tax. I think you mentioned it already, Ariel, applies when the gross estate of the decedent, the person who passed away, exceeds a certain threshold. Which is right now the 13.99 million in 2025. And then we also, the federal estate tax is assessed based on the fair market value of all the assets, like the real estate, stocks, bonds, other securities, personal property, business interest. And the fair market value is basically the price at which the property would change hands between a buyer and a seller. Generally, California does not impose an estate tax or inheritance tax. However, there are federal estate and gift tax laws that apply to California residents. So yeah, and I think I went through the exemptions. Yeah, I think I'm gonna pass it on to, and this is just an overview for the participants to see the comparisons between the United States in general, then California specifically, and then Germany in terms of federal gift and estate tax, the tax-free amounts as of this year, 2025, the applicable tax rates. And yeah, so Ralph.
Great, thank you so much. This is so helpful, Petra. Emily, we'll move on to your slides here.
Sure. So I'll talk a little bit about the US tax filing considerations. So if you give a gift over 19,000, and that is one gift to one person over 19,000. So if you have 100 friends who you want to give 19,000 to each separately, you're below that threshold. If you give 25,000 to someone, now you need to do a gift tax filing. And that is to, you have this lifetime exemption of 13.99 million. And every time you give a gift over the annual exemption, that reduces that lifetime exemption. So you need to report that to the IRS and tell them, I gave a gift of 119,000. So that's going to reduce that lifetime exemption by 100,000. So this is due same as your individual tax return. So it would be April 15th living in the US. If you're living outside of the US, extension to June 15th. If you file an extension, you can get the October 15th extension to that. And yeah, so if you're reducing you're giving gifts, you're a very generous person, you're giving gifts over this amount and you're reducing your lifetime exemption, then when you eventually have an estate, then that's going to be a taxable estate. So if you give a gift of 20 million, you've given a taxable gift, so you're going to pay tax on the 6.01 million. I think that's the right math. The amount above that exemption, and then when you do have an estate, that estate will be taxed. So you have, as Petra was saying, when you have a U.S. citizen spouse, you can give gifts, unlimited gifts between each other. When you have a non-U.S. citizen spouse, you're limited to give them 190,000 per year. And then everything above that 190,000 would be taxable. And yeah, very important. When you're receiving gifts from non-US people, there's a filing requirement. So if you receive a gift of over 100,000, gift or inheritance, over 100,000 from a non-US person, there's a filing requirement. It's not a taxable, it doesn't lead to tax, but you do have to inform the IRS that you received that gift. And that is an important one to timely file because the late filing penalties are 25% of the gift received. So if you're receiving a gift for 100,000 and you late file it, the potential penalty is 25,000, which is a lot. So on the estate tax filing side, the person who files that is the executor of the estate. And that's different than what's happening with inheritance tax in Germany, where if you are receiving the gift, you're responsible for filing it. And then with the US gift tax, where the person giving the gift is responsible for filing that. So the estate tax filing has to be filed if it's gone over that 13.99 million. So a combination of lifetime gifts plus the value of the estate. And in addition, the estate might have income, annual income. So for example, even if it's below that threshold, if someone passes away owning an investment account and that investment account is getting dividends, then they would be accruing to the estate. So there might be an income tax filing for the estate annually. I think the important thing here, particularly in one of the states where there's an estate tax, is getting local expert assistance with this. Estate tax is really a vast and complex area, and I think not only is it filing the returns, but also really understanding the process and the documents required and how that state is what their process, if they're going to send notices and how to address those notices, having a local expert in that state who really understands and has experience working with the state revenue office can be really useful. And we can go to the next slide. Yeah, so let's go back and talk about that Form 3520, which is reporting gifts from non-US persons. So like I said, there was a 25% penalty on potentially late filing it. The IRS was really aggressively enforcing these penalties for any late filing. Often previously, if you say if you give them, a good reasonable cause for filing it late, they would review that. And for a while, they just stopped reviewing it and were automatically sending these penalties. They agreed at the end of last year to stop doing that and to take a little bit more of an approach, of a common sense approach, shall we say. They've abated a lot of those penalties. And so, yeah, this is a great time to get that cleaned up. If you're hearing this and thinking, oh, I've inherited from, if you have a non-US citizen parent, for example, or relative, or you've received gifts, yeah, it's a good time to kind of clean that up and address it so that it doesn't haunt you later. So for the Form 709, if you've given gifts, if you're listening to this and thinking, oh, I've been giving gifts to people and I haven't been filing them. There are two situations really that will lead to penalties on that. One is if it's taxable. So if you've given away 20 million or 15 million and you haven't filed it, then you really want to get on top of that and file it before additional penalties accrue. And then the other penalty situation is if you significantly undervalue your assets. So that won't apply because you're not going to lie to the IRS. That's never a good idea. And if you don't have a taxable gift, you can late file it. And just go ahead and get that taken care of and cleaned up. There are a lot of things around this where it's so complicated, it's just better to be, on the straight and narrow with the IRS and have things clean. Even if it's late, it's still better now than 15 years from now to worry about it. And then a couple of things that aren't exactly estate tax, but I think can be income tax related that kind of fall into this. So if you are the beneficiary of an estate and that estate is generating income, that income may flow to you. So the executor of the estate, when they file the annual income tax return, they will report that income to you on a K-1 and it goes onto your tax return. That can happen. And also sometimes people are inheriting a retirement account from they're a beneficiary of a retirement account. And then when that transfers to them, it is distributed. And so that distribution goes onto your income tax return and will be taxable. And I think that people can get a little bit confused about that because it maybe feels a bit like an estate tax because you're being taxed on what feels like assets, but it's actually two separate transactions. So that's going, into the estate. The estate is filing a tax return, but maybe not a taxable estate. So it's not owing taxes, and then it gets transferred to you, and then it's being distributed. And so that becomes retirement income that you received. So that can go onto your personal tax return and you can have a personal income tax due from that. And if we go to the next slide, so you can do many complicated things for estate tax planning. Like Petra was saying, you can do many different trusts, family, I can't think of the word for Germany. You can do, yes, thank you, family foundation. I really like to start with, the low-hanging easy fruit for planning and make sure that that's being maximized, the things that don't require any planning or any filings. So the first of that is maximizing your tax-free gifts annually. So 19,000 doesn't seem like a lot, but that's per person per year. So if you have a parent who is going to have a taxable estate and you want to reduce that, then they can give you, if you start planning ahead of time, they can give you 19,000 every year. Over 10 years, it gets inflation adjusted. So that would be 200,000, and then that's per person. So if you have two parents doing that, then over 10 years, that could be 400,000. So maybe that's a little bit, making a little bit more of an impact. And then if you have a spouse and they're giving, maximizing that, both parents are maximizing that to both spouses. Now we're talking about 800,000, probably inflation adjusted would be getting towards $1 million. So if you're trying to reduce that lifetime or reduce the value of an estate, you can kind of drip it. The other consideration you can do is to think about what is being gifted versus what you're going to keep and receive in the estate. So there's something called a step up in basis, where some things that you inherit, the cost of that resets on the day that someone passes away. So if you have a house that was in, I don't know, New York, somewhere, San Francisco, bought in 1950, that has a really high value right now. So if that's gifted to you, then you're going to receive it at the 1950 value. If you sell it, then there's going to be huge gain on it. If you inherit that house, it will reset to the value right now. So then if you sell it, there won't be as much of a gain. Both of these situations, you really want to align it with German tax planning if you're a resident in Germany, because there will be variations in the rules and different gift limits, different step up and basis rules. So that is very important to align with experts who can help you with the entirety of the situation and look at it from every side. So with that, I'll hand it over to Ralph.
That is the perfect introduction for all of us.
Yeah, thank you for the introduction, Ariel and Petra, of the German inheritance and gift tax law, and thank you, Emily, for reminding some points about the U.S. State taxation and gift taxation. Yeah, thank you very much, especially for highlighting and pointing out the difference, the main difference between German about the difference between both taxation concepts. The U.S. taxes estates and Germany taxes mainly the beneficiaries. And I would like to come to 2 points. First is German tax reporting and filing obligations, and the second is I would like to talk about a little bit the tax brackets that is set out in the German inheritance and gift tax law. To the first point, the German tax reporting and filing obligations. The German inheritance tax is not dependent on citizenship, as Ayel and Petra pointed out. Foreigners are taxed under the same rules as German citizens if they are residents, or if foreigners have especially German assets like Germany located real estates. So yeah, what does residency means? If the heir or the deceased benefactor has or had their apartment and they lived in Germany, or they had their habitual abode in Germany, that means spent more than 183 days in Germany, then they are reliable for this kind of gift or inheritance tax. So the beneficiary has to file a report on all transfers received within 3 months of gaining knowledge of the taxable transfer. So the tax report has to be filed to a specialized tax authority responsible for gift and inheritance tax. So there is a limitation period of 4 years after the 3 months, and there's a limitation period of 4 years starting the end of the year of actual filing of this tax form, or after 3 years. And this limitation period can be extended to 5 or 10 years in the case of tax fraud. So a report that should be submitted should include the name and the address of the heir or the beneficiary, and the name of and address of the deceased person. So then there should be added a list and an estimate of the assets on that list and their values, and there should be the reason. Was it a gift or was it an inheritance case? So and then the tax authority decides if there will be required to file a separate tax form or not, if they make a real inheritance or a gift tax case out of this, or if is it a very small case that generates no inheritance tax for the government. So there is a separate evaluation process for real estate. There will be a separate tax assessment. It should be in line with a fair market value, as Petra pointed out in US tax cases. So, but if there is no fair market value available, then there's a tax law that helps to calculate the a kind of fair market value that has to be included in the tax form. The tax, there will be a separate tax assessment. So then the assessed tax is generally due. Can you?
Oh.
Yeah, the tax is generally due 1 month after the receipt of the tax assessment. There can be granted installments. Petra pointed this out in her slide. In very hard cases, it can be, but also if a business is transferred up to 7 years, or if a real estate that is rented out will be transferred, and there's no cash available to pay this inheritance or gift tax. So yeah, that are the general reporting and filing obligations. And then I would like to come to the next point, the German gift and inheritance tax brackets. As Ariel and Petra pointed out, that the German gift and inheritance tax law relies to relationships. So bracket and the German inheritance and gift tax law distinguishes 3 tax brackets. Bracket 1 is for immediate family members, spouses, children, adopted children, stepchildren, grandchildren, and parents and grandparents in case of inheritance. So, and tax classification 2 is for other family members like uncles, aunts, sisters, nieces, and nephews, for instance. So, and then tax classification 3 is for all the others, for friends maybe. So if you see here, the inheritance tax rates are between 7 and 30% in tax classification 1, tax bracket 1, depending on the value of the assets received. So, and then 15 to 43% tax classification 2, and tax classification 3 is the worst case. It's from 30% up to 50%. So, and the value is, you see also the brackets regarding the value. It's up to 75,000 lowest tax rates, and for more than 26 million, then it's the tax rates are very high. So yeah, that is then as you could see, there's a free allowance for inheritance tax for children. There's a base allowance of 400,000. It can be granted within 10 years. And after 10 years, another 400,000. It is important for tax planning purposes, according to in Germany related or German related inheritance or gift tax cases. And then there's a special allowance for a spouse or for common law partners of 500,000 mentioned beforehand. And then plus 256,000 for a spouse in a case of inheritance separate. It's not like these high amounts that you mentioned in these pure US situations for estate tax. And Germany has not increased these thresholds for decades, and at the moment, we cannot assume that they will increase these numbers. So, but there are opportunities for this tax planning. One, there are not all assets taxable. One thing I want to highlight is if a family property will be allocated to a beneficiary, a special allowance for family home based in Germany or the EU region exists. there must be continue living in this inherited parents' home for at least 10 years. It will be checked by the tax authority. So, and only 200 square meters is exempt from this inheritance tax. So, and the exemption does not apply to foreign properties and holiday homes and second homes. So there's another, if this is a family property, if this family property goes to a spouse, then it's also a special allowance, and without this 10-year limitation and the 200 square meter level. So yeah. Then important for German tax planning is what is the basis or evaluation of inherited or gifted taxes. Basically, the value of all the assets transferred. It can be a business, it can be shares, it can be properties. So, and then minus liabilities. So there are different liabilities. It can be a usage of for gifted property to children, if the parents hold back the usage of the usage of the apartment or the property, it will be evaluated and can be used as a liability against this gift tax. So there are several opportunities that can be used and in these situations. As it was mentioned beforehand, all the inherited assets within 10 years will be added, inherited or gifted assets. So, and this period is important for tax planning in this US-German relationship. So, and then the last point from my side, inheritance or gift tax paid in another country might be possible to use as a tax credit against the German tax. We have just spoken about assets in the US or assets in Germany. As Petra mentioned, that if there's one person deceased in Germany, then worldwide assets received by a beneficiary will be part of this inheritance and have to be added. It can be that a property in the United Kingdom will be part of received assets, and then if there was a payment of tax paid in the UK, it might be possible to use this against the German inheritance tax. So, okay, that is from my side. Thank you very much. And
Great. Thank you so much, Ralph. So now we're going to get into a little bit of a case study. We've got about 10 minutes left. And so we're going to use the last 10 minutes to just kind of go through some of the common examples that we see. So, and cross-border estate planning challenges between the two countries. So here's an example scenario. John's a US citizen. He moves to Germany and he is a German tax resident. So his father passes away and leaves him with his estate. So he receives a $2 million family home in California and a $500,000 taxable investment account. So, you know, what are the complications here? Because John is receiving a U.S. estate, we have to think of what do we have to do on the U.S. side, and then what do we have to do on the German side? It's a very common question. Again, what happens if I become a German citizen? Not much. If you're already a German tax resident, that's not going to change much for this scenario. So for the U.S. estate tax, and Petra, please feel free to jump in as well on this. So we assume that the total value of the estate is below the 13.99 million federal estate tax exemption. So we really only have the information on, okay, well, how much does he receive? So we're assuming that estate is below the current US federal estate tax exemption. So there's no estate tax due, and then no California estate tax considerations. So assets are then transferred to John as part of the estate settlement process. And for US tax basis, it's generally the fair market value of the property on the date of the decedent's death. There is an alternative date that you can choose, and then the estate would file any estate tax returns that would be due. Then let's go over to the more complex side, which I think we'll have Rolf kind of highlight here. So we've got the German inheritance tax side. So as a German resident, John is subject to worldwide inheritance tax liability in Germany. The individual is responsible for the inheritance tax filing. The German taxes may be different than the US tax basis. So we'll talk about that in a minute, Rolf. And then as a child, John would qualify for the 400,000 tax-free allowance under German law. And then with the German US estate and gift tax treaty, it avoids double taxation, but John would still owe the German inheritance tax. So the inheritance planning required by John's father would, like, the inheritance planning is required by John's father to reduce or eliminate German inheritance tax owed by John. And this is always so interesting to me because when you're talking about families in the US with large estates, it really just changes the conversations that the people who are German residents, oftentimes it's US citizens who are living in Germany, they're preparing to maybe inherit an estate from their parents. And it's a really kind of uncomfortable conversation. It has to kind of switch, and you have to get more involved in those conversations. And then Rolf, we'll get over to the kind of the estate planning challenges here. So the remaining taxable balance would be roughly the 1.9 million. So, looking back to the bracket there of what tax rate would be applicable in this situation, we'd be looking at about 19%. So there would be a $361,000 euro balance to the German tax authorities. And so this is why we highlight pre-planning is really important. This is basically like nothing was done. There was no planning. This would kind of be the outcome and why the planning would be important. I want to go back a slide, Rolf, and have you talk a little bit about, I know before the presentation, we were all talking about the different tax bases. And so we know in the US side, we have the step up in basis, but on the German side, what would be the tax basis of that home?
Yeah, there's a different they go back to a law that is called evaluation law, and there is a part for the land. What is there are prices for land around this area, and then the income generated of this property is a calculation basis for the building itself, or in certain circumstances the historical construction costs multiplied by a coefficient will create the value of this property. So there are a lot of cases where no value is available, an actual value. So we have this in certain areas where there was no sale in the last decades. So, and everybody knows that in Bavaria, for instance, the value is very, very high, but there's no real value available regarding the land and the buildings. So everybody knows that the value of these properties is very, very high, millions of euros. But if it comes to this evaluation process, it can be a couple of 100,000, 1,500,000, for instance. So that is we have these situations, that might differs the tax basis in both countries.
And Ralph,
what
does
about
that sorry, does that go into the inheritance tax calculation? And also it has the income tax effect for when that property is sold. Does that set the valuation for when the property is sold later?
Yeah, yeah. If a person inherits a property or a business or assets that generates income, then the income itself will be subject to income tax. So it's a separate tax, and it will be assessed in a separate tax bill. So yeah, but
So when you have this undervaluing or using the German valuation law to essentially undervalue this property,
yeah.
does that create the problem when that is later sold, that gain is going to be just astronomical?
Yeah, that is a good point. You mentioned this, and I made a note out of this, that when you receive a property as a gift or inheritance in an inheritance tax case, then you step into the footsteps of the deceased person, or of the granting of the person that granted this asset. So if you sell this property, for instance, and if it's a real private property, after 10 years, it's tax-free, tax-exempt according to German tax law. So if it comes to income tax. So it might be a couple of gains in the US. So, but according to German law, it's not a couple of gain that is subject to tax.
Yeah, and that highlights, I mean, we could probably spend another hour talking about that. That really highlights, just wanted to highlight, that does not exist in the US. So we have two different different systems on the gift and inheritance tax, and then even just on income tax, like the considerations on how we calculate that. Similar, but in some cases, like with property, can actually be very, very different. We have 1 minute left. I'm going to skip that slide. And then we have resource links that we're going to share with you. And then you can connect with Emily. Emily has a YouTube channel. I have an Instagram account. I also have a YouTube channel, but lots of ways to connect with us. I did miss the recording, the first part of this, which was basically my couple of slides and introductions. So I'm going to go back and re-record that right now. And then I will have my editor put everything together, and hopefully it's pretty smooth so that when you watch the replay, you get all the information. But we will make sure that you get that. That will likely arrive to you in your email early next week. So if you have any questions, I'll also be sure to share all the contact information for all of our presenters. And I can't thank you enough, Ralph, Petra, and Emily. Thank you so much for sharing all of your knowledge with us this evening. I hope you had as much fun as I did.
Thank you so much.
Yeah, thank you very much.
And I think this just outlines how important it is to plan properly.
Absolutely. Okay, great. Have a great evening, and we'll talk to you all soon. Bye.
Okay, bye-bye.
Thank you.